Well, welcome to Preserving Low Prop 13 Taxes, even if you missed the Prop 19 deadline. I am Jim Cunningham, and I'm going to take you through an alternative strategy to preserving your low Prop 13 taxes for your family. Now, this is very, very important. What I'm telling you here, and for those of you who've seen other videos, this is very important. This is not legal advice. I'm going through an approach that many times does not work, okay? And so this is not an end run around the rules that apply, but what I'm going to do is I'm going to walk through a few examples on how people in the past have preserved their Prop 13 taxes and transferred property to other people. So I'm Jim Cunningham. I'm an attorney with over 25 years experience. We have offices in the capital region, which is the Sacramento area, San Francisco Bay, and Southern California. I'm a certified specialist in estate planning, trust, and probate law. I'm also a real estate broker, securities licensed, and insurance licensed. Our firm helps people who are taxpayers to pay the least taxes possible. And our goal here is to help craft a plan and give you options, make some recommendations that may reduce your overall tax bill, leading to more wealth for you and your loved ones. Please subscribe to our YouTube channel if you're watching this live. You can go to YouTube and subscribe. If you're watching this on YouTube, please click the subscribe button. We have a lot of important content coming out. It is February 2021. And there is a big change, several changes in the law. So it's very important as a taxpayer, you really do need to pay attention because 2021 is going to be, in many respects, the most important tax year ever. So here's how Prop 19 changes everything for homeowners and real estate investors. So if you're here, you probably already heard about Prop 19. But Prop 19, which passed in 2020, requires an understanding of Prop 13 and an understanding of Prop 58. So I'm going to go through this very quickly. We have a lot of other videos on here where we take a real deep dive into what Prop 13 is and how Prop 58 works. But on a high level, here's what Prop 13 is. Prop 13 is California's property tax system, okay? Whether it's residential, commercial, industrial. Here's a residential example. Mom and dad buy a home in Cupertino for $50,000. Cupertino's in the Bay Area in the San Francisco Bay. It's also the home city of Apple. And real estate prices there have gone up tremendously in the last few decades. So in this situation, this example, this couple bought this house for $50,000. Now this property is worth $2 million. The assessed value of the property is $120,000. Now what is assessed value? Well, assessed value is the dollar amount that appears on your property tax bill. So in this couple, when mom and dad get this property tax bill, even though the value, so if they were to get the property appraised, right, by a certified residential real estate appraiser, that appraisal would show a market value of $2 million. What I mean by assessed value is something entirely different. Assessed value is what the county uses as the base to levy a 1% tax, okay? That's all this means. So in California, assessed value oftentimes is completely decoupled from market value. That is not the same in other states. And in this case, taxes are $1,500 a year. By the way, the next door neighbor, and this is not uncommon, especially in the higher priced areas of the coastal areas, typically in California, the person who owns a house like this is paying $1,500 a year, and the next door neighbor is paying $1,500 a month. And I will tell you, people don't like that. We live in a democracy. People say that's not fair. That's the system. And I'm not saying that Prop 13 is fair or it's not. What I'm just highlighting is that people pay wildly different taxes on similarly valued property when looked at a market value approach. But something to understand is Prop 13 protects you, the taxpayer, against higher taxes. And Prop 13 is a valuable property right in California that should not be squandered. It should be preserved. And so in our firm, we view the Prop 13 taxes as a valuable property right. So in California, whenever there is a change in ownership, and that's defined in the Revenue and Taxation Code, whenever there's a change in ownership, property by state constitution is assessed or is taxed at 1% of its fair market value when there's a change in ownership. So that becomes its new base year value. So what that means is if a property trades for $2 million, the taxes are going to be $20,000. Now in the real world, they're a little higher because there's some local add-ons depending on the city or the county that you're in. But on a high level, when property changes hands, when there's a change in ownership, it is reassessed at its fair market value, and the taxes are 1%. Change in ownership does include a sale, obviously, a gift, interesting, and death. So death is the little known event that is considered a change in ownership under California law. Now, the value of Prop 13 is even though when the property trades, it's reassessed, the taxes can only go up 2% a year. And so what's happened over the years in California is that property has gone up at 4, 6, or 8%. And meanwhile, your taxes are only increasing at 2%. And so the longer people hold property in California and the more that California property appreciates beyond that 2% annual increase, the bigger value that Prop 13 is for the taxpayer. And that's something that until very recently, we could pass to our children. So effective February 15th, can't do that anymore. There's no more parent-to-child reassessment exclusion. So back in the day, back in the pre-February 15, 2021 salad days, mom and dad could die, leave the house to the kids, and there's no reassessment if the kids, do everything they're supposed to do on time, file the right documents with the county recorder, county assessor, and the kids get to keep the parents' low Prop 13 taxes. So that was a really good thing. Well, that's what Prop 19 took away. Okay, so Prop 19 says you can't you can't have this parent-to-child reassessment exclusion anymore, just across the board on all properties. Now there's a cap, $1 million per person, or there was a cap, but it's very important to understand that these taxes did not go up. Now, if mom and dad die February 15, 2021 or later, it's a little bit more nuanced approach. We need to look at a couple of things. Number one, the first thing I'm going to look at as a lawyer, the first thing I'm going to ask is, do you want to keep this property? And if the kids say, no, we're going to sell it, okay, end of discussion. The second thing, though, is, were your parents living in the property? So if this is what is called the family home, and this is the language that is now in the statute, if it's the family home, there is a limited parent-to-child reassessment exclusion. And it is basically the assessed value of the home plus $1 million in market value. So if the assessed value plus $1 million in market value, and here's our example, remember the Cupertino house was $120,000 assessed value, then we add $1 million in market value. So the first $1.12 million is not reassessed, but guess what? The remaining $880 is. And that $880,000, when it's reassessed, increases the tax bill by about $11,000 in Cupertino, because they do have some extra add-ons there for property taxes. So the property taxes jump from $1,500 to $12,500. It's about as good as it's going to get with Prop 19. Now, the fact of the matter is a kid has to move into the family home. And by the way, we don't know what all this stuff means because the legislature hasn't yet passed legislation as of this date to give us guidance on this. But the bottom line is, it's got to be the parents' home, and then one of the kids has to move in there. So I don't want to get down too in the weeds on this. We've covered this on other videos, but I'd encourage you to take a look at our YouTube videos and explore that a little bit more if that's an issue for you. But again, a fairly limited homeowner parent-to-child reassessment exclusion. So again, this is a valuable property right that should not be forfeited just because someone passes away. Now, if you've already done Prop 13 planning, we were able to help out many, many people. There were far more people we were not able to help out. And a lot of people, quite frankly, are going to lose out on this valuable property right because the parent-to-child reassessment exclusion is gone, right, effective February 15th or 16th, depending on who you talk to. But if you've already done that, congratulations. But what if you tried, but you couldn't get help? We had people calling and they said, I want to hire you. And I said, I know the deadline's a month and a half away, but we can't take any more matters, right? We're full. We got to serve the people that reached out to us. So what can you do now to save Prop 13 taxes for your family? So I think people have this image of the Titanic. This is the SS Prop 13 or SS Prop 58, right? Sinking. And is it true that you cannot pass your low Prop 13 taxes to your children? Well, it depends. There's another way, okay? So there is the parent-to-child reassessment exclusion, but as Yoda said, there is another way, and I'm going to talk to you about that. And this is, again, very high level. So it's a long process, but if it's done correctly and under the right circumstances, it does work. And it's a method of transferring property between generations that, frankly, big corporations and very wealthy families have been using for decades. And big corporations and wealthy families have three things in common. Number one, they tend to hire the best advisors. And secondly, they take the advisor's advice. And third, they have a lot of money, okay? They have capital. They can deploy it in certain ways in a way that frankly benefits them and results in lower taxes. So to get from property from one person to another without being reassessed, it is possible. And this does include using entities like a limited liability company. And that's the example I'm going to use here. And perhaps over a period of years, perhaps not. And this is very important. This cannot be for purely tax reasons. We're going to talk about something called the step transaction doctrine. And I'll mention what a doctrine is. But the problem is you can't do a bunch of steps that if you put them all, mash them up into one, you can't put in extra fake steps in there, basically. So that's what the step transaction doctrine says. So I'll start by saying the gold standard going forward for long-term properties is what is called the original owner, having an LLC being the original owner. Now, what does that mean? So this is a new term, original owner. This is something that's used quite extensively in the Board of Equalization and in the rules and regulations when it comes to property taxation. But the first, right out of the gate, we say, is the entity, is the LLC the original owner or not? And I'll explain to you what an original owner is. Well, one of the benefits of being an original owner is the property might never get reassessed. If it's handled properly, might never get reassessed. So the original owner is when an LLC acquires property and the property is reassessed. And I'll give you an example here in just a couple of slides. But when you're not the original owner, if more than 50% of an LLC changes hands, the whole property is reassessed. So if you transfer 49, you transfer 50%, no reassessment. If you transfer 51, the whole property is reassessed. And that's very, very important to understand. With the original owner exception, it's only if one person gets more than 50%. So slight nuance there. So with the original owner, as long as no one person gets more than 50%, you're good to go. As long as control doesn't transfer from one person to another, you're good to go. But if you're not the original owner, meaning if you bought a property and years later you put it into an LLC and you are not reassessed when you put the property into the LLC, then that is not original owner status. And you'll see that's going to be very, very important. So original owner is a transaction where the property was reassessed when the LLC acquired the property, or if the property was owned before March 1st, 1975, which is a long time ago. We still get those clients coming in. So long as no one gets more than 50% ownership or control, the property might never be reassessed. And that's kind of a big deal. So here's an original owner example. Andy creates Franklin LLC to buy a multifamily in 1986. And so Andy sets up an LLC, and he is very thoughtful and mindful on how he sets up this LLC because it's written in a way that is Prop 13 compliant. Now, what do I mean by that? Well, there's a lot of stuff that you can put into an LLC that kind of screws up the Prop 13 planning, quite frankly. So whoever's doing this, whatever lawyer you happen to be working with, should be an expert lawyer when it comes to property taxation. And there are not many lawyers out there that are. You really need to pay attention to this. And this is very, very important. So Andy creates this Franklin LLC to buy this multifamily in 1986 for $500,000. And in 2021, the assessed value is now $1 million, but the fair market value is $3 million. So here's what's going on. The taxes are going to be a little over $10,000, but if this property were to get reassessed, the taxes would go to over $30,000. So that $20,000, that's what I'm saying is the valuable property right. So $20,000 over a 20-year period is $400,000. I think we can all agree, no matter what your level of wealth, $400,000 is not an insignificant sum of money. And this is sort of the long-term mindset that attorneys that practice in this area, at least expert attorneys, they bring this mindset to the client meeting, to your case. And so in 2021, Andy gives his LLC shares to his kids. He gives 50% to Betty and 50% to Charlie. He just gives it to him. There's no reassessment. None. Kind of cool, right? That's because Andy was the original, the Franklin LLC was the original owner. Done. Nice job. That's a way to preserve, right? It's a way to preserve Prop 13. Now, when the LLC is not the original owner, it means the property was not reassessed when the LLC acquired the property. That's kind of the fork in the road, right? Was it reassessed when the property went into the LLC? Yes or no? If the transferor or the person putting the property into the LLC and the transferee, the person who owns the LLC shares, retain the same proportional interest, then there's no reassessment. Okay, so you can put a property into an LLC, but if you own 100% and you put it in the LLC, you got to own 100% of those LLC shares. If you start mixing around, ownership, you're gonna run into potentially some problems. So, Andy buys this multifamily in 1986 for $500,000. In 1990. So a few years later, Andy transfers a multifamily to Franklin LLC, does not have it reassessed. In 2021, the assessed value again is $1 million. The fair market value is $3 million. Andy gives his 50%, his LLC shares 50% to Betty, 50% to Charlie. Same, right? Same transaction, full reassessment. The entire property is reassessed. Okay. Very important to pay attention to this. If we change the facts and Andy gives 50% of his LLC shares to Betty, but keeps his other 50%, there's no reassessment. So, because if you're not the original owner, so long as no more than 50% of the shares transfer, the property's not reassessed. So here's the big insider legal tip for the day. The big takeaway from today: consider acquiring property that you intend to hold long-term with an LLC, either at acquisition or after acquisition. But this is very important. The property should get reassessed when it goes into the LLC. So that gets you original owner status, right? So if you buy a property in March and you transfer it in June, yeah, you're probably okay. Your taxes probably won't go up that much. But that's something to think about. So as you work with your legal advisor, as you know, whether you choose our firm or another firm, but as you work with your legal advisor, these are some things that you need to think about. You know, I'm buying this property. Is this going to be something that I want to have be a legacy property for my family or not? Because there is some care and feeding associated with an LLC. It also gives you some protections, right? There's certainly some creditor protection to isolate any. You know, if there's a problem resulting from this building, you can typically isolate that liability to the assets of the LLC. So in this case, let's kind of take this a little bit further. And this is what lawyers do. They say, okay, well, that looks good, and let's take it a step further. So this is where you're not the original owner. So this is, again, where Andy buys the multifamily in 1986, and in 1990, he transfers it to the LLC, and the property's assessed at $1 million, but valued at $3 million. And Andy gives 50% of his LLC shares to Betty and keeps his other 50%. And there's no reassessment. And then here's what he does. He goes, you know, they decide they don't want to be partners anymore in the LLC for legitimate reasons, legitimate non-tax reasons. I'm going to explain this in a couple of slides. So they transfer the property to Andy 50% and Betty 50% as tenants in common. There's no reassessment. Now, I will tell you, the assessor's office does not like this. Many people are reassessed and they go up on an audit appeal, and sometimes people win and sometimes people lose, okay? But this is what's happening in the real world. This is what's happening with wealthy people, and this is what's happening with large corporations. Because we had this parent-to-child reassessment exclusion, what we used to do is we'd take the property out of the LLC, transfer it to the kids, put it back into the LLC, right? Problem solved. But now we don't have Prop 58. We don't have the ability by statute, right, to say I'm going to give up to $1 million in assessed value to my kids. So again, in the real world, when these deeds are recorded, the assessors are going to ask for all relevant documents, operating agreements, membership certificates, trusts, agreements, whatever they ask for. Yeah, you know, everything kind of sees the light of day on this one. You're going to have to provide that to the assessor, and they scrutinize them. And there's something that you need to understand, and this is the single biggest roadblock in this type of planning, is something called the step transaction doctrine, and it may result in a reassessment. And let me explain to you what a legal doctrine is. First of all, a legal doctrine is not a statute. So there is no statute on the books that says there is a step transaction doctrine or there's a step transaction. And that's, you know, that appears in civil code section umpity-ump. All right. It just doesn't happen that way. So a legal doctrine is really a framework. This is straight from Wikipedia. A framework, a set of rules, procedural steps, or tests, often established through precedent in the common law. Now, what that means is judges deciding cases, not legislatures convening and passing statutes, and judgments, meaning a judge. Judgments can be determined in a given legal case. So they do a case-by-case basis. And a doctrine comes about when there's this sort of consistent thread between many cases, and they go, oh, well, you know, enough judges come together, right? And then they kind of agree, well, this is a good doctrine to have. It's called the step transaction doctrine. Well, what is the step transaction doctrine? This is a fundamental tax principle. Okay, so this comes from federal, and California kind of picked up on this. You can't put extra fake steps in to game the system to avoid reassessment, right? There have to be facts other than tax avoidance present to avoid the penalty box of the step transaction doctrine. If the only reason for breaking the transaction into steps is to avoid reassessment, you're sunk, you're Titanic, okay? Game over, not going to work. There has to be more to the story. And this is not a how-to on to how to game the system. What I'm telling you is, if you're going to look at this and if you're going to meet with a professional, there really have to be reasons other than tax reasons to do this. And that's why I put the original owner as the gold standard. I would say that going forward, if you're going to acquire a piece of property and it's a long-term hold property, please consider using an LLC. Now, I'm not telling you to use an LLC because it's not legal advice, but please consider it and meet with an expert lawyer because you really do need to pay attention to this. There's so many benefits of an LLC being the original owner. Now, I know that's not going to help you necessarily for people who, who might have legacy properties. You could always consider half a loaf, right? You can give half to your kids. And then what I mean by that is, if you have this apartment building that we were mentioning, the Franklin apartment building, Andy could give half the building to his 2 kids, and then his 2 kids and he could put the property into an LLC, and then he could transfer his shares to his kids. So that's one way around of at least saving half of Prop 13. And that can be, that is not as subject to the step transaction doctrine. So I would say that if you're going to go down this path, what I've seen, the cases where it has been the strongest cases are these multi-year endeavors, quite frankly, where it's many tax years. So a tax year, meaning, you get a tax bill and there's a 2-year period, 2020 to 2021, that's a tax year. So a lot of these transactions should happen in different tax years. Again, not for purely tax reasons. There have to be a lot of other good reasons in there. And something to think about is, you have to take a gut check. And is this something, if the assessor is likely to reassess the property, are you going to be able to sleep at night? Right? Because if you can't pass that stomach check, that gut check, then maybe the strategy isn't for you. Again, a lot of people do it. A lot of people get reassessed. A lot of people survive it. It's kind of all over the map. But that being said, this is something that you won't know unless you talk to an expert, right? To have that dialogue, to have that conversation. So the headline here, though, is that there's no longer an easy way to preserve your Prop 13 taxes for your family now that Prop 19 is the law. And of course, this is short of looking up your assembly person and state senator and calling or writing a letter or email or I don't know, however you communicate with them. To get something on the ballot to bring back the parent-to-child reassessment exclusion. I've heard there are multiple initiatives out there to get something back on the ballot. We'll see where those go. Does it work? If the facts warrant the inapplicability of the step transaction doctrine, then I think it works. But the facts might not be there to overcome application of the step transaction doctrine. Again, this is a judicially imposed or sort of, assessor level imposed, like, oh, well, you did these 3 steps and really we know that second step was a fake step. So we're going to mash them all up and we're going to reassess you. You really have to pay attention to that. Okay. And this is a real world thing. And again, you won't know until you speak with an expert. So I would say that, and we'll get to your questions here in just a moment, but there's some nuanced approaches with different types of clients. So there's single or divorced clients. And I would put these in the class of unmarried but not widowed clients. And they have a slightly different path than the married clients. Something to know is that a transfer of property between spouses is by statute not a change in ownership. And so that opens up a tremendous amount of planning opportunities in this field going forward. Surviving spouse, what that means is you were married, but that the marriage ended in death. And so we might have issues of, remember the AB trust, the ABC trust, we've got that on some of our YouTube videos where we discuss that. But a B trust, a C trust are basically irrevocable trusts that are created after the death of a spouse. And those require some special attention. Also basis adjustment at death. So if you're going to be making a gift of property, something to understand is your low cost basis or whatever your cost basis is transfers to the person that you're giving the property to. And so that requires an analysis where you go, well, if you give this low basis property, you're just kind of kicking this tax can down the road. So it might make sense to hold on to this until death and get an adjusted cost basis. And then there's portability. So if you've lost a spouse recently within the last couple of years, you have not gone to a lawyer and sought out some expert advice, I would really encourage you to do that because this is your, frankly, kind of last gasp, in my view, of getting a very high exemption. Now, what does this mean? What is portability? So if my wife dies, she has currently an $11.7 million death tax exemption. I can inherit that. And so I put that together with my $11.7 million death tax exemption. So that's $23.4 million. So then if I died, 23.4 million can go tax-free to the kids. Well, what we're looking at now is the potential with the Biden administration is to reduce that exemption from 11.7 million all the way down to 3.5 million. That has the effect of increasing death taxes. So A $10 million estate wouldn't be paying death taxes under current law, but under the Biden potential, could be 2.5 million in taxes or something like that. So that would be, makes sense, right? I would want my deceased spouse's $11.7 million exemption because I can add that to my $3.5 million Biden exemption. And if you're like, I don't know what you're talking about, Jim, stay tuned. Subscribe to our YouTube channel because we're going to have a lot of information on this coming up. This is going to be a really busy year for estate planning attorneys. If you're married or a registered domestic partner in California, the term registered domestic partner is interchangeable with spouse. So those mean the same thing under California law. And most importantly, for property taxation. So if you're married, that is probably the greatest flexibility when it comes to Prop 13 planning. So if you're married, please don't miss this opportunity in this tax year 2021, of looking at some of these more advanced strategies. The more children you have, the better. I mean, just objectively, right, on a high level, but also the greater the planning options. So a person with one child, frankly, has fewer planning options as somebody with 2 children or 3 or 4 children. And again, I would seek out an expert with experience, and this is very important. And so I will open it up for questions. And let's see here, we've got a lot of questions here. Okay, Sunny says, can we print your slides? I don't know. If dad died in November of 2020 and daughter is recording now after the 2/15 deadline to transfer title to her name, can she claim parent-to-child exclusion since dad died in 2020? True, that is my understanding from the Board of Equalization. And, don't go to the bank on that. But yeah, I mean, the answer is yes. But again, this is not legal advice. I would certainly seek out an expert. Can this work for rental properties? Sure, it works for all real properties. Okay, so there's 2 answers to that question. Original LLC applies to everything. I mean, the big case was the Fairmont case with Michael Dell in Santa Monica. He's saving $1 million a year in property tax and driving LA County nuts. And he got sued by LA County, and Michael Dell won. Okay, so people do win on this, and there are ways of saving taxes. Can this be done with rental properties as well? Yes. Pat says, my elderly mother's house is not in an LLC. She has 1 child for her house. If that 1 child gets on house, the title is 50% owner, would the property taxes be reassessed upon inheritance? This assumes the inherited house would not become the children's primary home. Yeah, Pat, that's a tough one because when you add somebody, depends on how you add them to title. Again, not legal advice, but if you add someone as a joint tenant, that is not considered a change in ownership for California property tax purposes. If you put them on as a tenant in common, it is. So it's the words are very important on this one. But if the property, meaning if mom adds kid as a joint tenant on 50%, and then when mom dies, under those facts, the whole property will get reassessed. And I'm telling you, Prop 19, there's a lot of good stuff in Prop 19, a lot of bad stuff in Prop 19. Okay, it took away this parent-to-child reassessment exclusion. If you have properties in rent-controlled areas, you really need to think long and hard. It's like, all right, well, if my property is reassessed, like in this example, let's say the owner of the property dies and it goes to the children. When we were working with clients on Prop 19 planning, we kind of modeled this out, and we realized on several properties, the property taxes would exceed the net rents, meaning by the time you paid all the expenses associated with the building, the taxes, the maintenance, the insurance, the vacancy factor, all of that, there wasn't enough rent to cover the taxes. And so I was talking to an expert tax practitioner who's a former assessor, and he says, yeah, the assessor, they'll probably just value that at land value or some type of low use value. So I think we're going to see even more contortions, and Prop 13 has really contorted the way property is taxed in California. But I think we can see that in the future. So if you're worried that if you have a rent control property and the property is reassessed, maybe you inherit that property. If that property is reassessed and now the rents don't cover the property taxes, I am hopeful that you would have some relief from the assessor, but there's no guarantee. So we're really in uncharted waters on this one. Do you think with the passage of Prop 19, there will be a spike in the use of structures using this structure, opening greater scrutiny, leading to reassessment? Yeah, I think so. I think people are going to not have a choice. And I think these transactions do get scrutinized. And the point of this is not to tell you how to game the system. First of all, the point is, consider going forward, having an LLC for the original owner status. I think that is the gold standard. I think that's, certainly the most important thing. But on these other ones, I think it's a case-by-case basis. One thing you can't do is you can't come in and say, hey, lawyer, I want to hire you to game the system and avoid taxes with no other reason and avoid the step transaction doctrine. That makes it really hard because there have to be other reasons. You have to literally build a case around this. And so that's something that is a conversation that you have one-on-one with your lawyer. Let's see, Jim, I think people will be gifting their LLC shares this year because of the possible Biden tax plan. I agree. Then isn't it reasonable to move it into a new LLC for lending reasons? In other words, shouldn't these factors tell the story when it comes to the step transaction doctrine? Perhaps, and I think this is probably, of any year, maybe the best year to do this. And there's another thing I haven't told you. The step transaction doctrine before passage of Prop 19 was not applied to intra-family transfers, meaning gifts from parents to children. They did not apply the step transaction doctrine. Now, there is a memo that came out last week from the Board of Equalization. I think it's question number 27 that said, well, the assessors may impose the step transaction doctrine. Now, I will tell you as a lawyer, and I've met some other lawyers on this, we looked at that and we're like, well, what does may mean? Does that mean they're able to, or you're letting them? Here's kind of what's going to happen in the near term. I think each assessor's office is going to take their own view on this, quite frankly, and we're not going to have consensus anytime soon. If a new property is acquired by 1031 exchange and title is held as previous property, and when can we transfer the new property to the LLC, and will that be the original owner LLC? Yeah, anonymous, the basic idea, and I'm just going to articulate this as like fundamentally as I can. If you transfer property to an LLC and it's reassessed, the LLC becomes the original owner. That's how you know if it was reassessed when the property went into the LLC. Now, remember, if I own a whole property and I create an LLC and I own all the LLC shares, I can transfer that property to the LLC and not be reassessed as long as the proportional interest remains the same. I own 100% of the property. I own 100% of the LLC shares. The proportion remains the same. The problem is I'm not getting original owner status on the LLC. So I have fewer planning options going forward. My mom has 37% interest in my property. She is 98 years old. When she passes, as I understand it, I can claim homeowner's exemption in the first year. My tax base is $600,000. Therefore, I get $1 million exclusion. I would not pay additional tax if the property is worth $1.6 million or less. Yeah, Matthew, great question. Actually, recognize the name. Just go ahead and make an appointment. We'll talk about that for 15 minutes. Go ahead and reach out to us. I need some more facts on that. Anonymous asks, is this presentation posted? Yes, it will be on YouTube. We're not able to find some of your previous presentations. Thank you. Yeah, so they're on our YouTube page. So what I think is a great idea, go to our YouTube channel, subscribe to it. Once you subscribe to the YouTube channel, it appears in your feed. And then as our videos are released, they will kind of pop up in your YouTube messaging so that you're aware of them. Christina asks, any issues with banks loaning mortgages to LLCs? Yeah, actually, it's interesting you mentioned that, Christina. I've got a call with a client later this afternoon. Irrevocable trust, banks don't like to lend to irrevocable trust. Banks are, okay, lending to LLCs. And thank you for the softball question. An LLC is, many times banks do lend to LLCs. They may have different lending standards in terms of loan to value, but that's kind of typical for commercial anyway. It's kind of hard to get past the 65% loan to value. Do you co-counsel with other attorneys on these issues? Absolutely, Sally. We're happy to, and we did that in the Prop 19 thing, and we're kind of an open book. We're here to help our colleagues and frankly, the people in California, because I will tell you guys something else to remember. You got this Biden tax thing happening. People were panicked after Prop 19 passed. Our phones melted down. People kept calling us. We weren't able to serve people. The same thing's going to happen this year with the Biden tax plan. The reason I know, it happened before 2012, the fiscal cliff. I don't know if you remember that, but people were running around in a panic, right? They were in a panic. They were really worried about the decrease of the exemption down to $1 million. And, fortunately that didn't pan out. But I, in my heart of hearts and mentally have gotten my head around having a $3.5 million estate exemption, because that is the stated amount that the current administration, remember, they've got the White House, the House of Representatives, and the Senate I mean, I think you're just in denial if you think it's not going to be reduced to $3.5 million. So, and this is not politics. I'm not saying one way or another whether it's a good or a bad thing. I'm just acknowledging reality. And if you have a $5 million estate, you really need to start paying attention to this stuff, because the taxes are 45% under the Biden plan. They're 45% on amounts over $3.5 million. Well, that's a lot of money. That's like $600,000 on a $5 million estate, right? It's definitely worth planning for. Scott asks, what if your properties are in trust prior to February 15th, given there's no change in the owner, does Prop 13 still apply? Scott, that's a complex question. As a general rule, the Board of Equalization disregards, or the assessors disregard trusts. They look through trusts to see who the beneficiary is. They do not do the same for entities. So that's something that we could talk about one-on-one and see where you're at. Brian asks, what if an adult child was added to the deed before death? Brian, that's I'd have to look at the deed. And again, if you're added as a tenant in common, it's typically a reassessable event, unless there was a prior parent-to-child reassessment exclusion. Joint tenants is not a change in ownership. So if you add someone as a joint tenant, you're not going to get reassessed, but the whole property gets reassessed. You know, if mom adds son as a joint tenant, there's no reassessment. But when mom dies in the future and son inherits the property's reassessed. Can I book an appointment with you? Yes, Charles. I happen to live in Sacramento, but we're virtually everywhere now. I mean, virtually, literally, real. But I meet with clients in all the offices. Scott says, is it possible to move the primary residence to a tenancy in common arrangement with rights of survivorship? Will that avoid reassessment? You know, Scott, it's kind of a half a loaf. I think it'll get you part of the way. And we could certainly talk about that. And I think a lot of this is just kind of sucking it up a little bit as a taxpayer potentially and saying, yeah, you know, all right, well, we'll have half the property reassessed. It's better than all of it. So this might be not a full solution, but if we can get people part way, I think we're making some headway. So, and again, I wish I had clearer answers for you. I wish I say, oh yeah, this is what the rule is. The problem with legal doctrines is there's no statute, and we're not really sure how they apply. And so it's very difficult to say, oh, these are the 5 steps you need to do in order to avoid application of a legal doctrine. It's very tough. So Anonymous asks, a client, single woman in her 70s, plans to sell her condo in San Mateo County in April and purchase another residence in Santa Rosa, and won't be purchased until a later date. Client's daughter plans to contribute to the purchase price and plans to live with client mom. How does daughter's contribution to purchase affect client mom's ability to transfer the base year value from the San Mateo condo? Also, for what it's worth, the client's plan to leave the new home to the daughter after she dies. So this is a really interesting question. If mom sells her home and moves her, what we're talking about here is moving your Prop 13 tax base, which effective April 1st you can do. Sell your home in San Mateo County and you move up to Santa Rosa. As long as that property that you are selling is reassessed, you can move your property, your Prop 13 taxes. It's got to be reassessed though, right? So if it's a parent to child transfer, even that like the family home, you can't daisy chain these together like that, okay? Property has to get reassessed, then mom can transfer her tax base. That's something we should really look at, because I really don't have a clear answer on that. But I think if we had a discussion, there is a potential workaround on that. And it seems like you're a lawyer. We could certainly co-counsel on that. But a lot of this is, it's like measuring 10 times and cutting once. You need to go through all the facts. You need to look at all the alternatives. And then it's literally turning a screw a quarter turn. It's, maybe a 1-page document, the deed that you sign, but you need to know how to properly title, how to properly take title. So very nuanced area of the law that requires an expert. All right, so Grace asks, what if the property was owned by a trust? Who is the original owner, the trustee or the successor trustee, or who put it in the trust originally? So Grace, the Board of Equalization, the assessor, they ignore trusts. They look at who the beneficiary is. So they're going to look at who the beneficiary is on that one. George says, are you going to post this on YouTube? Yes, you can show it to your family. And then Emmanuel asks, what are the examples of other reasons to make it viable? There's, how long is a piece of string? There are a lot of other reasons. You start a business venture. A property is, you decide to move your business. There are a lot of different ways, but the point of this is not to give you a laundry list of ways to cheat the system. The point of this is to tell you what the rule is, which is there's no easy way, okay? There's no quick way to say, you know what? we're just going to do these documents over this period of time and poof, done. They're going to come after you. They're going to apply the step transaction doctrine. So it's a much more nuanced approach. Janine asks, if I'm the successor of my parents' trust, will I be able to keep Prop 13 if my parents couldn't reach the county assessor's office in time to submit paperwork before February 15th? Yeah, Janine, that was a pretty harsh deadline. I don't know the answer to that question. If you want to make an appointment, we can certainly go over and tell you where you're at. I mean, a lot of this is just knowing. I don't know about you guys. I don't like economic surprises. Okay. I mean, surprise party's great, right? I don't like economic surprises. I don't like getting a tax bill 11 months after I buy a piece of property and go, what? Where did this come from? So that's kind of what we're talking about here, is just knowing or anticipating what's coming down the road. Is there a yearly charge for an LLC within the state of California? Rajesh, yes. So there's something called the minimum franchise tax, and that's $800 a year in California. There's no way getting out of that. Other states' minimum franchise tax is $10, $15. I don't know why California chose $800. Go figure. Is there a hack around that? Is there a way around that? There is a way around that, and that is something called a Nevada limited liability limited partnership. And there's actually a board of equalization, not a board of equalization, but a Secretary of State memo that says if you form a Nevada limited liability limited partnership and you bring that to California and it owns California real property, you are not subject to an $800 minimum franchise tax. Now, for most people, they're going to be putting economically productive properties into these rental properties. And if you have rents and you have income from the LLC, that minimum franchise tax kind of melts away after you have some revenue. So it's more of an issue if you've got vacant land or something like that that's not income producing. And George asks, the Biden administration has been talking about getting rid of the stepped up basis at death. Yeah, I don't know if we had that in 2010. George, we had something called a modified carryover cost basis. It's where you got to pick and choose what $3.5 million in assets you wanted an adjusted cost basis on. And you got that, and everything else you didn't. And that lasted for about 11.5 months. Could that be out there? Yeah. I think it's unrealistic to totally get rid of it because, I'm sorry, if you've got somebody who's working a minimum wage job and they have got a $10,000 stock gift and they sell it for 20, and they're going to have to pay capital gains taxes on the 10,000 when they inherited it from mom. I mean, it's almost comical. Is ridiculous, quite frankly. So I would be hopeful that there would be some minimal kind of pick and choose. Well, I'll pick which assets to get an adjusted cost basis, but I would anticipate that would probably end up being the rule. Mark says, my understanding was that your Prop 19 trust was in part an irrevocable trust. Would that have protected the family assets from Medicaid? Yeah. Can you protect assets similarly with an LLC? A little bit more, Mark, a little bit more complex question. Typically, Medi-Cal planning is done with trusts because you need to make a complete gift of those properties. And if you put property into an LLC, you typically get LLC shares in return. So you're not getting generally much traction with Medi-Cal planning. How does not having an original owner status change the rules that apply to the property that is added into an LLC? Well, here's the big difference. If you have original owner status, so long as no one person gets control or no one person gets 50%, more than 50% of the shares, the property is never reassessed. Ever. Okay? Now, I'm sure if you're a lawyer watching this, you'd be like, well, I can think of an exception. I'm just saying as general rule. That's the big difference. If you don't have original owner status, when more than 50% of the shares change hands, the whole property is reassessed. And that's a really big deal. That's a really big benefit. So I would say, I would say look at LLCs to hold. An LLC is one entity, right? But it's the LLC is the most flexible entity because it has the benefits of being a partnership. And for real estate, most people typically want partnership level taxation, not corporate taxation, for a variety of reasons. But an LLC can be taxed as either a corporation or a partnership. But typically a partnership requires two people. But with an LLC, you can have a single member LLC that's taxed as a partnership. And that's why an LLC exists. Okay, that's why it was written into the statutes, because there was a gap. Because it takes two, you have to have two partners to have a partnership. Okay, you just can't have one partner. That's not a partnership. It's a sole proprietor. So it was very important for the legislature to add this flexible element, which is an LLC. What are some proven reasons that the step transaction doctrine won't be applied? There's a whole bunch of reasons why it would and why it won't. But again, this is case law, and there are a litany of cases on point, and you just need to pay attention, and you need to craft a plan in a way that does not result in reassessment. When do Bruce Ketron's clients get their appointments? I've already signed up. Pretty soon. We actually closed our office when Prop 19 ended. We closed for 3 business days to give our staff a break. They were all working really hard for you, for those of you who are clients. And now we're reopening, and kind of that Prop 19 wave is behind us. Trisha asks, what are the costs associated with maintaining an LLC? Again, $800 a year minimum franchise tax, probably a varying level of complexity on a tax return. You'd have to talk to your CPA about that, but there is some care and feeding. When mom passes, is the property reassessed with joint tenancy? It depends. If you're the original owners, it just depends. So if mom buys property, if mom and son buy property together and they're the purchasers of the property, then mom dies, no reassessment. Okay. So Mona asks, how can I see and hear? I'm on Zoom, but there's no connection. Okay. You can go watch that on YouTube. Does the conservatorship dictate over trust documents? Oh, conservatorship. Great question. Yeah, a court has broad authority. If you're in a conservatorship, a courts can have broad authority over everything. Next question is, can we put the parent's primary residence into an LLC? Do we still get a legitimate business purpose for putting the home in the LLC? I'm not going to say yes or no, but we typically don't put houses into LLCs. Now, many governors have their house in an LLC. If you put your house in an LLC, California governor lives in a house that's owned by an LLC, but you have to pay rent. Is it really a business? I think it kind of mucks up the waters, quite frankly. Could it be done? Yeah, but it's a special case. If 1% of a primary residence is transferred to a kid that takes it as their primary residence, will that 1% be reassessed if the property tax reassessment is less than $1 million on the fair market value? It's proportional. There was just a Board of Equalization memo that came out on this. I'm just going off memory. I believe it was purely proportional. So they would look at the portion. So there's $1 million parent to child transfer exemption, but you can't give part of it. It's proportional to the transaction. So you would be using up 1% of the $1 million exclusion, which would be $10,000. What does it cost to set up an LLC? Do you describe? What's the annual cost to maintain? That's something we can talk about. It's just, again, it's kind of how long is a piece of string. But this is not inexpensive planning, and this is literally a multi-year engagement. Okay, this is not small stuff. Lalit asks, can you discuss more what the cautions are of how the LLC to set up that you touched upon, using an attorney who's a property tax expert when you were discussing the original owner exception? Yeah, you really do need to use an expert, because there's notification to the Board of Equalization when it comes to entities, not the assessor, not just the assessor, but the Board of Equalization in Sacramento, right? BOE Form 100. So that's something that needs to be filed. There's a lot of stuff that happens. And so there's like 1,000 little details that have to be addressed. And if the one or two are missing, that may sink the whole plan. So it's very, very important. And I will tell you, one interesting thing is this area of law is a very small area of law. What I mean by that is, there are rich people and there are big corporations that own property, but it's very small. There's 700,000 families that were affected by the repeal of Prop 58. Okay, 700,000 families. This area of law is going to explode. So if you're a lawyer watching this, I would really encourage you to kind of learn this area so you can add value to the relationships with your clients. The Prop 19 trust is Medi-Cal compliant ? Since the property wasn't gift stacked, there would be a look back period, correct? Yeah. That's a Medi-Cal question. Anonymous asks, my mother reached out in early January and she was put on the wait list, but did not make it the final cut or get contacted before February 16. She's not heard back yet. Will your team be contacting those who are on a wait list to discuss this alternative LLC scenario? Here's how yes. So all those people who are on the wait list, if we did not have their email address, we called them to get their email address. So if this is your mother, I don't know if this can work. And then we invited them to this webinar, quite frankly. So, but that's something, if you guys are still interested in that, please please be patient, give us a call. We're trying to get through all of the people that we had a waiting list of over, it was in the hundreds. It's crazy. George asks, mom and dad, who are in their 90s, are original owners since 1982. They inherited a commercial property with tax base of $100,000 and $3 million valuation, currently held in the revocable trust. The current property tax is $2,500. The kids are the beneficiaries. Yeah, you got an issue going there, right? So it may be something where you look at preserving half of Prop 13, right? At least you get you get to keep half of it, and that's a fairly straightforward way. If you want to kind of get all of it, again, you're going to have this headwind of the step transaction doctrine. But George, please reach out to us and we can talk to you. Allison asks, in the case of a married couple, if the family assets are owned by only one of the spouses, if the surviving spouse is subject to reassessment or inheritance tax? No, Allison, it's very important. I'm glad you asked this question. Transfers between spouses are not changes in ownership. Property is reassessed when there is a change in ownership. So this is an if then. If there's no change in ownership, there's no reassessment. So transfers between spouses, not reassessable, okay? Let's see. Anonymous asks, does this apply to LLCs or C or S Corp? Can a foreign corporation get the same? Yeah, corporations and real estate, not a good idea. If property is held in an S Corp, when it is sold, you do not get capital gains tax treatment. So it's a real bummer. Other than using an LLC, how do we preserve the primary residence current property taxes for the kids? Well, very interesting question. Something I did not mention that we did cover on our Prop 19 is one of the things you're going to want to do, I can recommend that you consider doing, is taking a really close look at your property tax bill. Make sure that if it's your home, you have checked the homeowner's exemption. The homeowner's exemption is a way, the strongest way to show the assessor that that is the family home. By checking the homeowner's exemption when you die or transfer the property to the kids, let's just use the kids in air quotes, as long as a kid lives in that property, in the family home, you have $1 million reassessment exclusion, okay? So it's gonna save you property taxes. Now, if it stops being the family home, the Board of Equalization has said the property is gonna get reassessed, right? Or that exemption, that $1 million exemption goes away. So, Anne asks, can I give 1% of my 60% of a home that's worth $3 million to my child? The siblings own the other 40%. Later revest title, a lot in here. Later revest title is joint tenants. First of all, Anne, I like where you're going with this. The problem is if joint tenancy has to have unity of time, title, and interest, meaning 3 joint tenants have to be a third, a third, a third. It can't be, 60, 40, 20, 60, 20, 20, wait a minute, 60, 20, 20. You can't do that. It's got to be a third, a third, a third. So I'm not sure it would work, but reach out to us. If I sell a property and do a 1031 exchange, can I create an LLC and purchase the replacement property? Yeah, Sam, I would talk to your 1031 accommodator on that. Maybe, maybe not, but it depends. But I would say generally, yes, it can be done, but it has to be done the right way. Are you saying that moving an existing property into an LLC does not trigger a reassessment? Anonymous, I am saying that if the proportional interest remains the same, the property is not reassessed. If I own 100% and I put it in an LLC and I own 100% of those LLC shares, no reassessment, as long as the proportional interest remains the same. If I own 100% of the property and I've got 3 other partners in an LLC and I transfer that property to the LLC, the proportional interests are not the same, right? So the question is if it's a blanket statement, are you saying that moving an existing property into any LLC does not trigger reassessment? No, I'm not saying that at all. I'm saying that certain transactions do not have reassessment. Let's see. There is a question on Prop 38. And then our last one, can mother's home title currently under the living trust be transferred to tenants in common, mother and daughter, to avoid full reassessment? So once one passes, the other will be reassessed 50%. Not quite, but you're onto something. Yeah, and this is kind of this is where you get into the step transaction doctrine. Okay, you can't take an extra fake step that if you didn't take that fake step, you can't take that extra fake step because the government, the assessor, compresses all these transactions into a single transaction. So I would say, Anonymous, you're on the right track. I think that's something we should discuss. I think there's a way potentially to at least have half the property not reassessed. And I think for many clients, if that's as good as it's going to get, they might go, well, half is better than none. Okay. And that might be where a lot of people end up, quite frankly. Is there a difference between property tax considerations for a second home versus a rental? Not really, but the economically productive property, probably a little bit easier to deal with, quite frankly. If a person transfers property to an LLC and keeps 100% of the shares, can that person transfer their 100% interest to their joint revocable trust and still avoid reassessment? Yeah, because if the proportional interest, to put context, I put the property into an LLC and then I put those shares of the LLC into a living trust for me and my spouse. Transfers between spouses are not changes in ownership. So I think you're probably good there. But again, not legal advice. Don't run out and do something. Regarding the primary residence under Prop 19, if the fair market value of the property is greater than the assessed value, plus $1 million, the entire property will be reassessed. No, it's only the difference, right? So the example we had, the Cupertino house that was worth $2 million, the assessed value was $120,000 plus $1 million. So that's $1.12 million of $2 million in value that is not reassessed. It was only that extra $880 that was reassessed. Okay, so it's only the difference. But if the kid stops using the home as the family home, then that exemption goes away and the taxes go up. In the Prop 13 trust your firm created, does it matter if the parents still write the check to pay the property tax, or should it be paid from the trust bank account or the kid's bank account? That depends. That's case by case. It really hinges on whether you want the property in or out of the estate when somebody passes away. Can you explain what it means to be an original co-owner where the property is acquired or inherited and contributed to an LLC? Yeah, here's what you need to understand. Original owner status, what does that mean? On a very high level, all original owner status means is when the original owner bought the property got reassessed. That's all that means, okay? So original owner means when that transaction happened, the property got reassessed. Parent to child reassessment exclusions, you're not an original owner, okay? Because you fall under an exclusion. So it's that original owner is when the property is reassessed. And that's how I think about it, because these terms are confusing even for lawyers, okay? Lauren asks, I think we already covered that question. Are there other reasons of saying, a lot of these are, and then Fam asks, I bought a house for $250,000. Now it's $1 million. If I sell it and buy a house for $1.4 million, can I keep the same property taxes I currently pay on the property of $250,000? Fam, effective April 1, the new rule is you can take your property tax base with you. And if you buy a property of greater value, and in this case, it's $400,000 more, you add that $400,000 increase in market value. You just add that to your taxes. So basically you get to, the way your math works out, you get to keep your assessed value at $250,000, and then you sell your house for $1 million, and then you buy another house for $1.4 million. So that $400,000 difference in the sales price of your home and the purchase price of the new one, that $400,000 difference is added to your tax base. And it doesn't matter anymore if they're in the same county, effective April 1. Father passed away in 2018. Mother is still alive but ill. 706 with no portability. Is my father's pre-Prop 19 tax assessed value protected when my mother passes and the beneficiaries receive their distribution? Anonymous, we need to have a conversation, because here's what happens. If your mom, as I understand this, your dad passed away, AB trust, the half that's in your dad's trust is for the benefit of your mom. When your mom passes away, that's when the transfer of your father to the children is deemed to occur, which now is after February 15th, which means the property is subject to reassessment. So there might be some work that we can do on that to help you out potentially. So at least saving half of it. So I would definitely give us a buzz. And Anonymous says, if a kid lives in one unit of a multi-unit apartment and their parents pass away who lived in another one of the units, yeah, this is, does the $1 million exemption apply to the entire inherited multi-unit apartment? I don't know. This has been an issue that's come up. This is, in many areas, you have multifamily properties. I frankly don't know the answer to that. I don't know if they're apportioning it or what they're doing, but they are working on it, and there will be an answer. So for the primary residence, if the child will not live in the property, how will we protect the primary home if the LLC is not advisable, or can we use an LLC? Well, I don't know. We'll talk about that. You may be limited to just keeping half of it. So on that happy note, go ahead and subscribe to our YouTube page, and go ahead and sign up to make an appointment. And I look forward to seeing you guys in the future.